Hello, everyone. We are here to talk about SPACs and the current environment of SPACs. My name is Michael Tenny, an audit partner here in the New York, New Jersey area in the financial service space, focusing a lot of my time and attention on SPACs as well as private equity and venture capital.
Hi, everyone. My name is Mark Deters. I'm also a partner in the New Jersey, New York area. I work in financial services and emerging growth and startup companies. I also spend the majority of my time in the SPAC market. I've been doing SPACs for probably about 15 years now. So we're excited to jump in and talk through what a SPAC is, the recent events around SPACs, as well as the market trends that we're seeing, and then just some differences that we can go over on public company versus private company thought process as you're going through possible exit strategies. So we can jump right in from here.
So if we start off, some of you may be aware of what SPACs are, but some may not be. So just a quick little refresher on what a SPAC is. Essentially, a SPAC is a shell company set up by a sponsor to bring in public money into an IPO. And eventually, once you raise that IPO, you go out, and the purpose of that SPAC is to find a private company to bring public via that public shell company. The SPAC, the only significant assets in a SPAC are the money I raised in the IPO. That money is held in a trust account and can't be used for its operations. It's just there for the purposes of acquiring a company. And that SPAC, as I mentioned, is sponsored by a team of investors, usually potentially be private equity funds or high-profile individuals.
One thing to note on that trust account, as Mike said, the SPAC needs to use 80% of that trust account in the acquisition of the private company, which is an important note, because if you have a pretty large SPAC, the valuation on that underlying company needs to be pretty significant, or you have to bring in additional target companies to make that number. So right here we have SPAC statistics. This is pulled from SPAC Insider. As you can see, there's 462 IPOs of SPACs in 2021, which is outrageous. I mean, the jump really started, I want to say, the second half of 2020 that the market really took off. I don't know if COVID drove it and everybody was at home and looking for different ways to raise capital and do different things, but we really saw a significant spike in 2020, the end of 2020. As you can see, 2020 had 248 SPACs IPO, a big jump from 2019, which had 59. And then in the first quarter of 2021, we saw significant SPAC activity on the IPO front.
Yeah, I mean, to Mark's point, I mean, the numbers here are staggering. There's been a lot. SPACs have been in the news prior to summer of last year. You barely heard about SPACs on CNBC and other news outlets. Now, you hear it daily about SPACs, and you can see, some of the reason why. Look at the numbers, right? I mean, you go from one SPAC in 2009 to 462 in 2021, and it's not even over yet. So definitely a hot investment vehicle these days.
And it's really, from what we've seen from the client bases that we've been working with, it's really shifted into an extra arm of private equity venture capital. A lot of the SPACs being sponsored are from different fund groups and investment managers versus, in the 2017 through 2019 area, it was mostly repeat SPACers that you'd seen in the marketplace that were really just focusing their attention on the SPAC world. But now I think in the 2020, 2021 era, we've seen a lot more. It's really just another investment pool by private equity.
It's its own asset class, right? I mean, it's making up 50% of the IPO market, just SPACs alone. So it's here to stay, for what, as they say.
Just some notes here. The majority of the SPAC IPOs in the current year in 2021 occurred in the first quarter, which accounted for 298 of the 462. We saw a significant slowdown starting in the second quarter of 2021. lot of regulatory scrutiny coming down, including on the accounting side, which is what we deal with, but we also saw a lot of different bulletins coming out from the SEC on different disclosure requirements in the S1s of SPACs. And then the real game changer from the accounting side was a change in the accounting for the SPAC warrants, which the SEC had issued a public statement on in April of this year, which forced many SPACs to restate their financial statements, classifying the warrants as a liability versus the traditional equity treatment that they were garnering. The other thing that's happening lately, I think we're seeing more in Q2 into Q3, is the market conditions now. They've forced the sponsor teams to change a lot of the different economics of the SPAC, as well as they're putting additional money in and overfunding the trust account. They're sharing their sponsor promote, which is their founder shares, with different investor groups to entice them to invest in their SPAC in the public offering, as well as they're reducing the life of the SPAC from 24 to 18 months. So those are some of the key terms we're seeing change.
Yeah, agreed. And then, so they're increasing some warrant coverage as well, providing more warrants. And some even having a little bit more, some more SPACs now are sort of sector focused versus bringing more in general. So we're seeing different things change as they evolve. The slowdown happened, there was definitely a big slowdown in April, May, June. Right now, it's starting to pick up a lot again. I mean, not to the numbers obviously we had in the second half of last year and Q1 of this year, but things are picking up again.
I think what you really need to see, to at least the way we've always seen the SPAC market ebb and flow, is you need to see a lot of successful closes of the target companies, and the post-close trading activity needs to be good. And then money, that money, as you get closes, those investors, there will be recycled capital back into the market from the SPAC side, and then you'll see the IPO market usually pick back up a little bit. But it's been tough, I think, with the regulatory scrutiny. There's also a bill in Congress now trying to change legislation on the SPACs as far as who can invest in them and when. I think there's a push to have only institutional investors in SPACs, unless if they reduce the amount of value that the sponsor groups that are launching the SPACs, I think I saw it was 5% that the sponsor could get in their promote of ownership in order for a retail investor to invest in a SPAC. That legislation's in Congress right now. It isn't, from my understanding, nothing's final, but that's what we've seen at least happening from the regulatory side.
We'll talk more about the SPAC a little bit, but yeah, the SEC is definitely going to put more out there on what they want to see in the disclosures related to growth projections, internal controls, risk factors, stuff like that. So definitely scrutiny on it, but it's obviously good for it's good for SPACs, it's good for the markets and the environment. So
and just a quick stat there is you see 321 regular way IPOs in 2021, and SPACs had 462. So it is definitely a large share of market in the IPO world. Here's the status by year of IPO. This shows how many SPACs are searching, how many have announced a deal, as well as completed a deal, which I think they're looking for additional closes. There's just too many in the marketplace, I think, right now searching for a target company.
Yeah, you can see 469 currently in the market still searching and haven't announced any business combinations. So there's a lot of potential deals and a lot of these SPACs that may end up liquidating in the end.
See, it's interesting though. We talk about liquidating. I think it's, in the old SPAC world, it was, the key term of the SPAC is you can, from a protecting investor perspective, is you can get your money back. So you buy the share at $10 and you also get the warrant with it. And when you go to the business combination, you get to vote on it and you can actually put your share back and get your $10 back plus interest and still keep the warrant. I think the key feature that changed, I want to say it was probably about 7 or 8 years ago, was if you actually redeemed your share, you couldn't vote yes on the transaction. now the SPACs are structured where you can vote yes and still redeem your share. So while we may see some liquidations, if these groups can go out and get additional capital to offset redemptions, we can go into that a little bit more. You're still going to see deals close, but they may be forced across the finish line and maybe shouldn't have closed, and they're going to have poor post de-SPAC trading.
I mean, the SPAC sponsors do need a healthy pipe market for that, and also there is some SPACs that do forward purchase or guarantee backstops in the de-SPAC, so they have a committed capital already.
Yeah, I mean, as you can see, like we pulled some stats. The 144 SPAC mergers have closed in 2021 so far. Lately, though, we're seeing significant redemptions. Like the overall 2021 redemptions 39%, but since August 1st, it's above 60%, which then, as Mike said, you have to go out. There's a minimum cash requirement on these closing conditions. So you have to go out, the SPAC sponsor is going to have to go out and usually get a pipe or, bring in additional capital to make that minimum cash number with redemptions like that.
Yeah, and then what we have, the current average market price of de-SPAC companies in 2021 is $9.09, which is obviously trading below. So all SPACs go out there at a price of $10. You don't want to see it below $10, but that's the average. So there's clearly some deals in the marketplace that have not been performing, but of course you have also deals that are performing.
Yeah, and the other thing, it's hard to pin it just on the company itself. I think the market conditions currently are tough for any operating company for the most part. I mean, despite the decline in market conditions, you still have some really good deals out there. You have we highlighted a couple here. The Vesper Hydrofacial deal was trading above $25. I mean, that everyone makes money in that deal. You can strike your warrant, which is $11.50. So I mean, all the investors in the group on that deal are doing pretty well with it. You have the Mountain Crest Playboy Enterprises trading above 23. Churchill Capital Lucid at a little bit below 23, and then I think the historical winner of the SPAC merger transaction has always been DraftKings Diamond Eagle deal, which is still, I mean, their high point was well above 50, but they're still trading around $50, which was a very good transaction for the SPAC market as a whole. And we were fortunate enough to be the auditors on the SPAC on that deal and involved in that transaction.
Yeah, that's one that's always brought up as a success story in the SPAC world. So Mark mentioned this before, but I want to just kind of touch on some recent developments in the SPAC world, especially as it relates to accounting. As Mark mentioned, the SEC did release a public statement back in April that kind of halted the SPAC world and resulted in 300 or so restatements.
Which really, also included operating companies that had already de-SPAC'd, merged with a SPAC. It wasn't just specific to the SPAC market.
The SEC, identified a couple of terms that were kind of buried in the warrant agreements that were, after interpretation, came to the fact that they should have been liability classified versus how they were traditionally accounted for in equity treatment. So we had to go through that kind of process with restating financial statements, and the SPACs have now presented those warrants as liabilities. But now, as they were fast forward a few months after the SAP statement, we're seeing a lot of the new SPACs alter the warrant agreements to obviously not preclude it from equity treatment. Just sort of saves. It's really more of a cost and a hassle more than anything. From what we heard from our sponsor groups, that it's not really doesn't really affect raising money or anything like that.
Another recent development in SPACs is the temporary versus permanent equity treatment on the financial statements. This is more recent, I would say about a month ago. We're not seeing a trend that's going to halt the market like the warrants did. This doesn't carry over into the operating companies. Historically, there was a holdback in permanent equity for SPACs where you would keep equity at $5 million, above $5 million. And recently, the SEC's informed accounting firms and issuers that they don't want to see that holdback anymore, and all the shares will be into the mezzanine temporary equity line item. That one's still a work in process with the issuer side of it, but it doesn't look like it's going to halt the market similar to, or in a manner that the warrants did.
Yeah. Anchor investors and valuation. So because of obviously some of the market conditions around SPACs, sponsors have to get more creative, as we mentioned earlier, putting additional money in trust at the IPO, and also getting anchor investors. And really what that means is they're going to have investors buy in the public market, and they're also going to sweeten it by providing them with B shares that will be given to them at the business combination. So that from an accounting perspective, that creates an offering cost related to the offering. So there's a fair value of those shares, and it's recorded in the financial statements and disclosed.
Yeah, and I think that part of that push too is I know the SEC really wants to demonstrate to investors how much compensation or money these sponsor groups make on a close of a business combination. And this gives you an insight into that by showing a valuation of those shares, which I mean, it's tough to really pinpoint the value on day one of what they're going to be worth on a business combination. That's still pretty far out, but that's kind of where we're falling with that one.
So we want to talk a little bit about SPACs. So once they do IPO, they're now, the hard part begins where the sponsors go out and look for a target. And one of the areas we see that kind of holds some of that process is when they do find a target, sometimes they're not audit ready or public company ready. So just kind of want to touch a little bit on that. So, but in general, SPAC does identify a target. They have to prepare a proxy statement that requires a shareholder vote. So all the public shareholders who get the vote on, as Mark mentioned, they can still redeem and vote yes for a combination. But that SPAC will file a proxy. It will include the financial statements of the SPAC, the target. It will include MD&As, unaudited pro formas, and other comparative data.
One of the big things, because the SPAC doesn't have any real significant activity, as you saw in the definition, one of the companies that's being acquired, sometimes it's multiple, but most of the time it's one, will have to be designated the predecessor of the company once it's combined, which will drive the presentation of the financial statements in historical numbers comparatively that you're showing, as well as moving forward.
Yeah, and to the point, if there's only one target, it's pretty easy to determine that the predecessor is going to be the target company, as the SPAC really, just has cash and trust.
And this is an important step as you go through the business combination, determining the accounting acquirer. You're going to have to figure out so the legal acquirer is always the SPAC, right? Because they're acquiring a company. But the accounting acquirer really drives how the transaction is accounted for. So you have to almost it's like thinking about a VIE and who's going to control the entity post-merger, not who's, the SPAC obviously is legal, but the accounting one gets a little more complicated.
And then this slide kind of goes into what you need to do for I would say 98%, 99%, if not even higher than that. Typically, the operating company will be the accounting acquirer. Really, the only time a SPAC is the accounting acquirer is that they do take control. They're looking for a company to run, to sort of manage and be on the board of. But for the most part, you're going to have the operating company as the accounting acquirer, and it just really, from an accounting perspective, that just shows the pro forma being presented in a different way. If the SPAC is an accounting acquirer, it's a traditional business combination where the target's assets and liabilities assumed will be fair valued. And if the operating company is the accounting acquirer, it's similar to a capital effusion, or we call it reverse recapitalization.
And everything comes over on historical cost on the reverse recap. The issue with the main, forgetting about just the minutia detail of the account of if the SPAC's the accounting acquirer, what it does is it delays your timeline to try and close the transaction and present pro formas, because if there's hard assets and equipment and different things, land, you may have to get into appraisals.
Yes.
And different things, and it really just delays the timeline to try to close the transaction. So yeah, I mean, it's funny, we laugh about like the accounting, especially in like, we've been seeing startups and even pre-revenue companies be acquired by SPACs. And, you laugh and you think, oh, the accounting's the last thing that comes in those companies. And even in a 200-page, 300-page voting proxy, the accounting is not that big within it, but it's usually it can be the biggest holdup in the process.
Yeah, as a SPAC sponsor, it's not the first question they want to ask the target, but it's probably one of the first few questions they should ask, and just understand where they are from a financial statement perspective. Are they audited? Are they audited under private company standards? Are they audited under public company standards? Who their auditor is, just kind of what kind of internal control structure they have, because the SPACs do allow some targets to have an easier opportunity to go public, but if they're not ready, it can cause significant delays in the de-SPACing process.
Yeah, I mean, the key delineation between acquiring, because really at this point, right, a SPAC can be an exit strategy or a capital infusion strategy. And as opposed to being acquired by a traditional private equity or venture capital group, the SPAC is the public company. Those financial statements of the target company have to be presented as if they're a public company, including the auditing standards being under PCAOB standards. Yeah. That's a big difference.
Yeah, and the accounting as well, as mentioned on the slide here, typically a private company, if they have goodwill, will elect to amortize that goodwill in the private company standards. You're unable to do that in the public company, so you would have to unwind that in order to get your financials ready to go into a SPAC proxy.
Public company disclosures, revenue recognition that explodes the disclosure requirements. There's some shortcuts private companies can take.
Of course. Just some other items on the proxy statement. Of course, they do need to also include an MD&A, so which is different than what a private company would typically do. There's also historical financial statement data and comparative per share information. Just so when you do file your first proxy, the SEC will obviously go through a review process. The initial review typically takes 30 days. You figure most of the time they'd file 3 to 4 to 5 amendments before it became effective, depending on the quality of obviously the proxy statement.
Most of the financial statement comments are really driven off of the target company, because this is the first time the SEC is seeing those that set of financial statements. I mean, I think unfortunately, it's a really important item within that closing process, the audited financial statements of the target. As Mike and I both said, it creates significant delays. I think where we see the most struggle, where it delays the process the most, is the independent standards are also a lot stricter under PCAOB audit versus AICPA private company, where you can maybe do additional services that in the private world that would impair your independence in the public side. So we've even seen instances where when the company tries to, with their auditor, their incumbent auditor, to convert the financial statements over, the auditor's no longer independent, and then you have to go out and get a whole new audit firm to re-audit those financial statements, and that's not really that quick of a process because it requires 3 years.
And that's typically the reason why reason why they're not independent on SEC standards is because they're either helping with tax revisions, they're helping with drafting financial statements. So we see that a lot, and you have to, as Mark mentioned, you have to get a new auditor that's go through and re-audit that company. So again, a significant time delay, and we didn't even mention, I don't know if we mentioned before, but the SPACs do have a finite life. So I think it was one of the slides. Typically that was 24 months, but now we're even seeing 18 months and even 15. So there's so that definitely squeezes the time frame there. And if you do find a company that's not PCAOB ready, then you're going to be getting to the end there pretty quick.
Yep. And then once you get through that whole voting proxy process, to close after the close of the transaction, you have to the public company will file a Super 8K within 4 business days. This will, usually you're going to change, there's change of control, required disclosures, shell company status. Also, there could be updates to financial statements required. But I think the key note on this slide is typically when a public company acquires another company, they get a 71-day extension on the 8K filing to include financial statements. In the SPAC merger, it doesn't. You don't have that extension. So it's a really quick turnaround time, especially if you're crossing a reporting period and financial statements go stale.
I know we're almost out of time here, so our contact information is on the screen. Would love to discuss SPACs with anyone who's listening. Feel free to reach out to us, and obviously open up for any questions.
Yeah, thanks for your time, everyone, today, and please let us know if you have any questions.